Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. Okay, so once again, the narrative does seem to be shifting, as it always tends to. Price action kind of leads the narrative. So we've seen, resilient jobs data time and time again over the last few months, stickier inflation, an explosion in semiconductor stocks, have all provided investors with some optimism again. And we mentioned yesterday the extreme greed that is popping up in some of these fear and greed indices. Now the SOX index, the semiconductor index, the outperformance of that index on the first chart here, it shows you it's quite a good leading indicator for South Korean exports, and those themselves are a barometer for global activity. Okay, so if you're trying to get a feel for where the cycle is, where the economic cycle is, those are the type of things that you're looking at to get a lead indicator on that. Now, if that relationship holds, you can see that you would expect South Korean exports to turn higher because semiconductors are absolutely flying. Okay, now the trouble is, if that happens, then the hard landing that many people are afraid of, and the reason why a lot of cash levels are still quite high, if you look at things like the Bank of America Fund Manager Survey, this is it. People are worried about the recession. They're holding on to cash. They're positioned fairly defensively. But if this semiconductor move is anything to go by, we may get a cyclical upturn. Okay, now I would argue that this semiconductor move may be an anomaly due to the AI developments that we've seen. And we've just gone to inflated valuations in these stocks as fast money has just jumped on that AI trade. And we know that's happened, right? So the recession scenario may still be on, and this may be a bit of a false signal in terms of what the semis are doing. That's probably the camp that I'm in. But we do need to be sympathetic to the fact that this often has led the cycle, and it certainly has turned up. Now, markets are obviously pricing in more chance, 75% chance that rates are unchanged in the meeting this week. But the July meeting is very live. And we are likely to get more hikes. The yield curve inversion, people obviously have talked about that being inverted for ages and being a recession indicator. But these guys, research affiliates, put out an interesting chart showing that if you look at the yield curve inversion in the 10-year yield versus the 3-month bill yield, and you look at that as a percentage of the treasury yield, then that percentage, that inversion is as steep as we've ever seen it. Okay, so that's here at 49%. And they're saying that is the reason why they think a hard landing is very likely. The stress on the banking and financial system that this type of yield curve inversion is done too much damage already. And obviously we started to see the cracks in the banking crisis that was happening in March. Now market has obviously kind of looked past that a bit, but the idea is these guys are banging the drum saying, yeah, we're not escaping a hard landing, basically. So you've got two schools of thought. You make your own mind up which side you sit on. I'm probably going to sympathize with the hard landing camp, but I am a bit of a bearish person because I've been an index trader my whole life. And that's just the bias, unfortunately, that we have. So we have to learn to control that bias. So even though I'm generally a bit more bearish, that doesn't mean I'm always all in short on the book. And those who follow my overlay portfolio will know, yeah, I've been putting some tentative short trades on, but I've been doing them in very contained ways so that they don't blow me up, basically. So that's generally how I've been riding this. I haven't been on the rally. I have got some long exposures in my long-term book to ride the rally, but in general, my tactical positioning has probably been more cautious and more bearish, but I haven't just been slapping out big short positions that have been hurting me. I've been doing it in a very contained way. All right, moving on to our dashboard. So you can see here stocks rallying to new year-to-date highs on S&P and NASDAQ yesterday. Now, we did see yields obviously ease back from local highs in the front end. We've got CPI today, obviously, and that kind of helped support tech stocks. So tech stocks continuing to rally. NASDAQ was up nearly another 2%. Commodities were mixed. Oil was down 4%. Uranium was up 3%. So they're seeing various divergences in there. Additionally, we have seen the PBOC cut their RRR rate, which has lifted copper and some other commodities overnight. The dollar has been treading water ahead of the key macro data this week. And once again, we saw ARK rallying, outperforming the other sectors, up another 2%. So, we did say ARK, once it broke that 40.5 level, it was going to have a go. It's done another 5% since then. I think it's getting a bit late. We may get one final push this week. But, if you've had tactical longs in ARK, I think we're getting pretty close to the end, to be honest, as we're starting to see these meme stocks come back to life and speculation going up again. Looking at equity skew, we did see it firming in S&P and NASDAQ, whilst the Russell remains weak in terms of skew, because Russell obviously had a fair amount of call buying that has kept a bit of a bid on that upside. So Russell skew lower, whilst the others were a bit higher. European and Asian skew also coming off. Asian skew in particular looking very flat, sub 1 vol point. Obviously, Nikkei has been firing to the upside, is now taking out 33K and looking strong. We had a bearish signal that we flagged a couple of weeks ago, didn't really play out. That bear move lasted about a day or two, and then it ripped back to the upside. So no point fighting that trade anymore. And then other skew moves, we saw HYG skew bouncing half a vol again, and that had got pretty oversold. It is still pretty low percentiles, but just interesting to see that. And then ARK skew getting offered, basically that upside in ARK really firming up quite a lot compared to where it was. I mean, if you look at the ARK skew, it was at about 10 vols not that long ago. It's now down to 3 vols, right? And the absolute levels about the money vol haven't changed that much, basically. And then in vol in general, we did see a nice bounce in vols, even though the market traded higher. And this is exactly what we were talking about with our friend Darius Dale from 42 Macro recently, saying we thought in the next leg higher, vol would go bid with the market. So we saw the VIX trading up with spot. That is not something you see every day, but it is based on the fact that vols had got oversold. And as we trade higher, we've kind of gone past that point of peak gamma that the market had. And we're now running away from the gamma that the market has, which means the market kind of actually wants to buy back some vol because it's at such a low absolute level. And if you manage to do a 90 basis point move on the S&P, that's about a 15 vol realized. So why do you want to be too short gamma on a 10 vol when it's realizing 15 basically, right? So these are sort of reasons why we're seeing spot up, vol up. Looking at energy vols, they actually caught a bid as well, about 3.5 vols, recovering about half of last week's drop. FX and bond vols grinding a bit higher as well ahead of the data this week. Obviously, we've got a lot of key macro data that we talked about yesterday. Most indices still in negative carry. And then we're seeing some positive carry coming back in the likes of Nat Gas, copper, and then obviously we've got FX has got quite a bit of positive carry, as has ARK. ARK's realizing 15, 16, but it's implied at 38. So definitely a bit of juice to harvest there in ARK, if for those who have got that tendency to want to sell gamma. Okay, and that's kind of it for the summary. Now, what am I looking at? What's on my radar? Oil. So oil pretty unloved right now. You can see that sentiment's changed a lot from where it was a year ago. Every man and their dog was bullish oil, except maybe Jared Dillian, who is Mr. Contrarian. I think he's bullish now. He certainly wasn't bullish a year ago. But anyway, every rally we've seen, every pop we've seen in oil has got sold, and it's got sold quicker and quicker. So you can see that here, all these pops getting sold, pop there getting sold, pop there getting sold. And the last one on OPEC got sold pretty fast. So, you know, we do think that with the momentum swinging a little bit higher, so a bit of a divergence in momentum as we're approaching that local low again, means that we don't mind dipping our toes in a bit here. Although if this level breaks on USO, this last support level around 58.5, we could definitely see a test down towards 50. So I wouldn't be overly surprised to see that as a final sort of exhaustive move in this sell-off before we get a more meaningful bounce. But if you want to dip your toes in here, we don't think it's a bad time. We are obviously starting to see China stimulus. Well, small tentative China stimulus moves coming through, like cutting various rates. If you are underweight commodities in your portfolio, especially energy, and you believe there are structural reasons, you know, you're in the Zoltan Pozar camp and you think there's structural reasons to be long commodities because, you know, the whole sort of polarization between the different blocks and people wanting to hoard resources and things like that, then we think doing bullish risk reversal starts to make sense. Selling put strikes where you are happy to hold on to your longs. You know, 50 on USO is 20% below current levels. So, you know, to get into some longer term allocations down there in oil doesn't look like a crazy idea. And you know that if OPEC are already trying to support the price, what they're going to do, what they're going to be doing to the price 20% lower, basically, right? So these are the considerations. So, you know, looking at our dashboard, we can see the strategy compass is putting us somewhere between buy calls and bullish risk reversals, right? Because obviously spot is oversold here. We've got vol still relatively low in terms of the range. That's why it's not up here where it's a more mid-range volatility. So what do you, and then you've got skew here over 5 vols, which is still relatively elevated in terms of where it can be, because we know skew can flip completely the other way towards a call premium if we do start rallying. So in general, that's where we sit. So what sort of trade would you do on the back of that if you were looking to pick up some upside in oil? All right, that's it for today's trade. Thanks a lot for listening, everyone. Sorry about the throat. I'll catch you all tomorrow. Cheers.